Well, China actually does like silver. They've been buying enormous amounts of gold. We've talked about that. But historically, China has always treated silver as a precious metal. In fact, until fairly recently, they settled their balance of trade in silver. That's and they like that. So they're part of it. But there's a lot else going on, and we don't know all the facts. But there have been some supply disruptions in the London market, and the lady named Blythe Masters, she was the head of commodities trading for JP Morgan for a very long time. She's moved on to other things now, but she was referring to gold, but it applies to silver. She said, gold never settles. And what she meant by that was, if you look all the paper transactions, forwards, futures, options, unallocated, agreements, settled with banks, the amount of paper gold, but this would be true of silver also, relative to the physical supply, is probably 100 to 1. So as long as everyone's rolling the contracts over, not demanding delivery, etc., the market works fine. But the minute some segment of the market says, you know what, give me the silver, I want physical delivery. All of a sudden, the commodities exchanges and the warehouses, the custodians are saying, well, wait, we don't have that much silver. They have to go get it. I'm not saying there's been a default, but what I'm saying is, all of a sudden, there's a scramble on the physical side to keep up with the paper side. You can never keep up with the paper side. It's way too big. So then you get into the dynamics of a short squeeze. So that's driving it. But I've said all along, if gold's going where I expect, and I've given a forecast to my readers in my newsletter, Strategic Intelligence, of $5,000 by the end of 26. I called my editor the other day and I said, we have to publish quickly because I'm going to hit that before we publish the forecast. But
I was going to say, are you going to move that forecast now?
Well, I probably will. I mean, candidly, it would not surprise me, not even a little bit, to see $10,000 gold before the end of 2026. I think we will. I like to be conservative in my written forecast because it's good to be right. But $5,000 is within reach. But $10,000 would just come as no surprise for gold. But
because
my
you
point is,
always said, wait, sorry, Jim, I just want to give you kudos here.
Go ahead.
You've always said, since I've known you, once we hit $4,000 gold, you said sky's the limit.
That's right. And there's kind of like a fifth grade math issue here. It's not complicated, but
as gold smashes record highs and silver races towards $70, Jim Rickards dismantles the mainstream story in his final pre-Christmas warning. He argues this isn't a simple bull market, it's a structural shift. Geopolitical fragmentation, rising nationalism, and the expansion of BRICS are colliding with a monetary reset that includes the quiet revaluation of gold. According to Rickards, soaring metals signal a deeper reality, eroding confidence in the post-1945 dollar-centric financial order. Nations and investors alike are seeking neutral, sovereign stores of value, assets beyond any single government's reach. In that context, gold at $10,000 isn't a fantasy. It's a logical outcome of a system losing trust.
So people think of the dollar price, $100 an ounce for $1,000 an ounce. And let's say you have 50 ounces and gold goes up $1,000 an ounce. Well, you just made $50,000. And if it goes up another $1,000 an ounce, you just made another $50,000. So that's true. But people get anchored on the $1,000 benchmark and making $50,000. But what they forget is that each $1,000 benchmark is easier than the one before because you're working off a higher base and it's a smaller percentage. And just to give a concrete example, when you go from $3,000 to $4,000 an ounce, that's a 33% gain. But when you go from $9,000 to $10,000 an ounce, that's only 11%. That's like a good week the way gold's been going. So my point is, you're like, hey, it took a really long time to get from 3,000 to 4,000, which is true. But so therefore it's going to take forever to get to 10,000. That's not true because it'll make its way to 5 or 6, but it's going to go 7, 8, 9, 10 really quickly. So silver's along for the ride. You at that point you're looking at $200 an ounce. I mean that's not even a stretch. The people talk about the gold to silver ratio. You can calculate it. It's just a number. There is no fixed ratio. This goes back to some 19th century lobbying campaign by silver miners. People talk about 16 to 1. That was a political lobbying thing. There's nothing natural about it. Having said that, there's no way gold's going to where we're talking about $5,000 to $10,000 an ounce. The silver's not going to move also, which it will. So $200 silver would be in the same vein as gold going to to $10,000 an ounce. Well, first of all, you're exactly right. The Fed is practically irrelevant in a lot of ways, not just the price of gold, but in terms of monetary policy and so forth. We don't have time to do a deep dive on the Fed, maybe some future show. But I would, yeah, you're right. That's just some Bloomberg writer trying to get through the day. Fed has nothing to do with it. There are drivers of gold. There are fundamental drivers. Now, some of this is momentum. It gets going and people jump in, but we're not at the crazy, momentum stage where, it's a retail outlet. People were lined up around the block. I mean, there's some places, but we're not there yet. But there are some really deep fundamental things driving gold. One of them we've talked about before. Central banks are net buyers. That tipping point transition that was in 2010. From 1970 to 2010, central banks were net sellers. Since then, they've been net buyers, but the number of central banks joining in and the amount of net buying is continued to increase. So that's just a good fundamental driver. And it's important for investors because central banks are actually pretty smart buyers. They mess up other things, but they're pretty good when it comes to buying gold. They don't chase the price, but they kind of put a floor under it. No guarantees, but they buy the dips, to use a cliche. Russia's a good example. They're very transparent. They would just put in a standing order, 10 tons a month or whatever. They didn't want to disrupt the market, but if they see a dip, they'll buy it. So you've got it's great for investors because you have all the upside. But the downside is kind of limited because the central banks will step in. So that's number one. Number two, good old-fashioned supply and demand. The supply has been flat for 7 years, around 4,000 metric tons a year, up a little bit, down a little bit. I'm not saying peak gold or gold output. There are no more gold mines that are out there, although they are getting harder to find and more expensive to mine. But demand keeps going up. So at least where I went to school, demand goes up and supply is flat. The price goes up. That's how you make the market work. Institutional investors are dipping their toe in the water. And the thing to understand about institutional investors, now I'm talking about sovereign wealth funds, endowments, big mutual funds and so forth. Their allocation to gold is tiny. It's like 1 or 2%. You would think maybe it's 5 to 10%. It's not. 1 to 2% is the right order of magnitude. If they just went from, let's say, 2% to 3%, that's not like a huge move, but just go from 2% to 3%. The amount of dollars involved was so large that, there's not enough gold in the world at these prices. That's something that would shoot the price even higher. That's starting to happen. So, and then the fourth element I would list is, we still have the bombs and missiles, but a lot of 21st century warfare is financial warfare. And a lot started with the effort of really the EU, but the US was involved at the early stage to steal $300 billion of treasury securities from Russia that Russia bought them legally, made the money on oil, bought them legally, put them in a custodian in Brussels called Euroclear. But when the war broke out in 2022, those were frozen. That's to be expected. But Europe took steps to steal them and use them as collateral for a loan to Ukraine. So Russia would be financing Ukraine in a war where they're fighting Ukraine. It was a crazy idea. It seems to have died down, but it was out there discussed for years. Well, if you're Saudi Arabia or Japan or Taiwan or Brazil or any large holder of U.S. Treasury securities, you're looking at that and saying, hey, what if the U.S. doesn't like something I do? What if I'm on the blacklist someday? Maybe I ought to diversify into gold, and they're doing that. So you have, again, I'm not saying they're dumping treasuries. That narrative is not true. But as new reserves come in, they are buying more gold. So these are really fundamental things that are pushing the price up and are going to keep it there.